Where are mortgage rates heading in the next 12 months? If you're waiting for mortgage rates to drop in order to buy a home, well, you may be disappointed for at least the next year or so. We will probably never see mortgage rates at 2.65% for a 30-year fixed rate mortgage again. That was stupid and irresponsible. We could take a look at this 30-year fixed rate mortgage chart by the Federal Reserve. And since the great financial crisis from 2009 until the spring of 2022, the 30-year fixed rate mortgage hovered somewhere around 4% or less, bottoming out at an all-time low of 2.65% in January of 2021. Do you wish you would have bought a home back then? Oh yeah, and in December of 2020, the median home price was about 30% cheaper at $309,000 than it is today at around $404,500. Guys, that's a whopping $95,000 cheaper for the median priced home just several years ago. So for the buyers today, rates are about 7%, and in many markets, homes are 50 to 80% higher than they were in 2019. And now it's time to pay the piper. Yeah. Or is it? With increasing home inventories nationwide, let's take a look at this chart. Right around February of 2022, inventory levels had basically dropped off to the lowest that they had in many years. But as you can see now, as of October of 2024, we're right about the same level of home inventory as we were in December of 2019. And now with inventory climbing, sellers are facing the reality that they're needing to drop the price significantly to attract buyers into saying yes to their home with today's mortgage rates. Now let's take a look at some numbers. Your traditional 30-year fixed rate mortgage is made up of principal, interest, taxes, and insurance. We refer to this acronym as PITI. So basically, we're going to talk about principal and interest. I don't know where you're buying a house, so it would be impossible for me to know what your property taxes or your property insurance would be on an annual basis. So that's something you'll just have to figure out and adjust for. But what we want to look at here is the difference between a 5.5% mortgage rate and a 7% mortgage rate, which is about where we are today. Now, at a 5.5% mortgage rate, your multiplier is going to be $5.68 per $1,000 of loan balance. At a 7% mortgage rate, your multiplier is going to be $6.66 per $1,000 of loan balance. So for the purposes of this exercise, let's just assume that you bought a house at $450,000 and you financed the whole thing. We'll just keep it simple. So at 5.5%, your monthly mortgage payment for principal and interest is going to be $2,556. At the 7%, for the same unpaid balance, your mortgage payment is going to be $29.97 per month. Okay, so that's a difference of $441 a month, or $5,292 a year. So you can see it's a significant difference for a loan at $450,000, the difference between a 5.5% and a 7% mortgage rate. So this is wherein lies the problem. We've seen home prices soften and home sales stall to 40 and 50-year lows because of this very problem. So if you're not planning on getting a raise anytime soon to make up the difference between the 1.5% of interest rate, you would then have to start looking at, well, I may not be able to afford a $450,000 house, or better yet, maybe I can negotiate that $450,000 house to get the same payment of the 5.5% interest rate. I would need to discount that house or negotiate a $65,000 savings, or in other words, that $450,000 house would have to become $385,000. So I think that, what we're going to be looking at over the next 12 months or so, maybe even longer, is the potential for sticky mortgage interest rates, which is going to create the need to drive these home prices down. So for the sellers that have their homes just sitting on the market, dropping your price in dribs and drabs, if you must sell, you must consider the cost for today's buyers to obtain financing, not counting the higher costs of property taxes, insurance, HOA, and condo fees that have skyrocketed in the last 5 years as well. This is now why many sellers are slashing their home price, trying to get buyers in the door. So for many sellers on the market today, the last several of years really gave them a false sense of security. They thought they had a lot more equity than they might have right now, or that home buyers would continue their exuberant buying spells where, they would just buy the house as is and overbid and get stupid money from mom and dad to just hand to these sellers. So really that whole last 5 years of historical data is preventing them from moving on with their life, quite literally. So they're holding on to their houses or taking them off the market, hoping that spring will be better, or just being very reluctant to negotiate. So these sellers are having a hard time. Now, let me also caution you sellers, if that is what you're thinking, that, buyers are no longer lining up to overpay for your home without an inspection. So not many are buying homes as is with broken down end of life and out of date features. These days may be long gone. So what should buyers and sellers be expecting with mortgage rates over the next 12 months or so? This chart on CNET.com, Fannie Mae, National Association of Realtors, Wells Fargo, and the Mortgage Bankers Association have placed their predictions of where they think will be fourth quarter of this year right now, leading into 2025. And it looks like everybody is predicting that by the second quarter of 2025, we'll see the 30-year fixed rate mortgage south of 6%. In a recent podcast that we haven't released yet, it's actually coming out next week, I interviewed Santiago Capital's CEO, Brent Johnson, where he follows the bond markets very closely, and he believes that the 10-year Treasury, which, by the way, predicates mortgage interest rates, the 30-year fixed rate mortgage, he believes that these rates on the 10-year Treasury will be higher than they are now going into 2025, maybe even for the entire year. And he is not optimistic that these mortgage rate predictions are true. Let's have a listen.
In my world, almost the whole world is priced off the 10-year bond, right? And so if 10-year rates go up, I think it'd be pretty rare to see the 10-year rate going up and mortgage rates crashing. Now, here's what I would say, though. So in general, I think rates tend to go higher unless they crash. In other words, I don't think that they slowly tick down and go lower unless there's some kind of a crisis, in which case people rushing to treasuries as a safe haven and the yield goes from 4.5% to 2.5% over a couple weeks or something like that.
Do you think these predictions are wrong based on what you're saying with the bond market and the 30-year fixed rate sort of following that 10-year?
Well, if they had these rates dramatically lower than they are now, I would say it's wrong. Again, unless there's some kind of a crisis or a crash. In general, I think they're wrong, but perhaps not dramatically. Again, I don't necessarily think 10-year rates are going to 8 or 9%. I just don't think that they're going to come down in an easy and measured way. And my guess would be that unless we have some kind of a crisis in the first 6 to 9 months of 2025, I expect yields to go higher into the first part of 2025.
Yeah, that would blow these projections, away. So what's my opinion? Well, I think it's just going to have everything to do with how well the Trump administration and the Federal Reserve work together to try and maybe keep the dollar strong. And by doing so, not participating in so much quantitative easing. But I think that the pressures of the housing market may push these rates as these predictions suggest. But the question really is, will even another percentage point or a percentage point and a half cheaper on a 30-year fixed rate mortgage be enough to prevent a housing price correction that many have been expecting, including myself? unless homeowner insurance, property taxes, and housing-related costs drop significantly, or unless we see major salary increases over the next 12 months or so, home prices, in my opinion, are going to continue to fall. Guys, we rode this thing hard. The buyer exuberance was just out of control from, really 2020 into 2023. And I think that we're going to continue to see home prices fall, and I'm still calling for that housing market crash that I've been talking about for the last 2 years. And one final word here is that whenever you're talking to a loan officer, whether you believe these predictions or not, I do not treat them as the gospel. One of the biggest things that I hate that loan officers seem to coin this phrase, date the rate and marry the house. What they mean by that is don't worry about the interest rate today. Go ahead and buy the home. You can always refinance later. And guys, you can't always refinance later. What they don't tell you is that it is costly to refinance, but the loan officers get paid again when you do, and you still have to pay your closing costs again. And if the housing market does weaken, as we expect, and it has been weakening, you might actually have to bring more cash to the table to close, and not a whole lot of homeowners have that. So if you're looking to buy a home in the next 12 months, I have a new course that's coming out. I want you to send me your email so that I can get you on this distribution list. We'll be providing all of the inside tips and tricks to get your best deals when buying a home. I think it's going to be very timely for the spring market. And no matter how good or bad your agent may be, should you decide to have an agent at all, you're going to have enough tools that you'll be able to save in any market. So send me your email. We'll get you on our list, and we'll see you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.